So let's have a look. US worried about the practice of foreign controlled companies being used to harbour income. So what they do, they designated that a foreign corporation is called a controlled foreign corporation if the US shareholder owns at least 10% of that company. And if this US shareholder owns more than 50% of voting power or fair value of the stock, then the income is called subpart F. Wow. So now, that subsidiary, if it is a controlled foreign corporation, okay, all right, in order to avoid being that, you have to be a US company that owns less than 10% of the company and actually control less than 50% of the voting power. Wow, which is very unusual, okay? It's very hard to have control with just less than 10%, all right? And now the income that comes from that is called subpart F income. So what we're going to do is there are two types of subpart F income. Subpart F, tax haven. All right? All right, that's one type. Okay, we're going to come to this. And over here, what you want to do is try and get your overseas subsidiary to have a safe harbour. Okay? All right? This is your strategy. You want to be here, you don't want to be over here. All right? Okay? Because what happens is, if you're a subsidiary, okay? If you're a subsidiary, and if you're not a safe harbour, it's likely you're going to be generating income that may be under subpart F. So let's have a look. It's either one or the other. So let's have a look at what the meaning is. Okay? So what do we mean by safe harbour? Okay? We're talking about subpart F income over here. When you have income from insurance, companies engaged in international boycotts, illegal payments, foreign-based company income. So we're talking about non-manufacturing income. We're talking about you have a company in another country, but it's not making money by manufacturing stuff. All right? Like Baidu has a subsidiary in the Cayman Islands that's selling services to Baidu in China, and then it's listed in New York, right? That company in Cayman Islands is not manufacturing anything. All right? Now, fortunately for Baidu, Baidu is not a US-owned company. The China one is. The Cayman Islands is US-owned, all right? So it's sort of a little bit different here. If less than 5% of the income, there's no taxable income. If it's greater than 70% of total income, then 100% of the controlled foreign corporation's income is taxed currently, all right? So what we want to do here, once you have a safe harbour, then you have the protection of, well, you only get taxed when you pay a dividend. You with me? All right? Okay? So to get to here, you've got to avoid having 90% of your income. If less than 5% is in 1, 2, 3, 4, then you're okay. But if between 5% and 70% is in 1, 2, 3, 4, then part of it is going to be taxable. Whether you pay a dividend or not, boom. If you're not in a safe harbour, a safe harbour means that you're safe. We're not going to deem your income to be like over here, like immediately direct income, until you pay a dividend. But if your income is non-manufacturing in nature, if your income is associated with insurance, it's with a certain country, certain illegal payments, foreign-based company income, it's kind of manipulable income, and it doesn't look legit, then it's going to be classed as subpart F. Then any income you earn is immediately going to be deemed as income. Okay? Whether you pay a dividend or not. Remember, over here, what is your big protection here? It's the fact that you can pay a dividend. Here, there's no dividend, all right? See, that's the big difference. You can delay your income equal dividend, except if your income is of a certain type, even if you don't pay a dividend, whatever you earned, income. Let's go over this again, all right? If you're a branch You're just like an individual. So every dollar you earn, immediately you pay US tax. Oh, how do I avoid that? Well, you need to set up a subsidiary. But most multinationals don't set up a subsidiary until 1, 2, 3, 4, 5 years later when they're starting to earn profits. Why? Because then they want the protection of not being able to be taxed on their income immediately. Because a branch, when they're immediately set up, don't make much money. Normally they're making losses, and that's perfect. You don't need that dividend protection. You know, the delay of dividend protection when you're making losses. All right? You want those losses to come back home immediately. So a branch is perfect for that. And then you actually morph into a subsidiary where you have the protection of deciding when you want to declare that income by when you pay a dividend, right? Ah, great. Oh, but there's a catch. We'll get that catch in a minute. Let's follow my graph here. But that's okay. You can have that protection of dividend only when, all right, obviously if you're a controlled foreign corporation, which most corporations are unless you have less than 10% ownership, which is very rare, right? You have to make sure your income is a safe harbour type, all right? Or it's going to be over here. If it's over here, tax haven, and then bang, it's deemed income. You don't have protection. You cannot delay. Even if you don't pay a dividend, they say, oh, what income you earn? Bang, we're going to tax you. That's where you don't want to end up here, all right? If you're over here, your aim is to be here, so you have that protection of when you pay that dividend, decide when you want to pay, when you don't want to pay, like Apple, okay? All right, quickly, time's running out. One thing I didn't explain. Under US tax law, when you move from the branch to the subsidiary, guess what? Capital gains tax. Oh man, the US tax man, they got you. Gotcha. All right? So you're done if you do, you're done if you don't change into a subsidiary. All right? You want to change into a subsidiary so you start to decide when you bring back money home. All right? But as soon as you change over, boom, you've got to pay capital gains tax. Wow. Isn't that complicated? Wow. Okay, so I hope this framework helps you a little bit more. Put your hand up. Does this help you a little bit? And that's not in the textbook.